The Fan.
Welcome to your commercial-free, uninterrupted investment show, sponsored by the SEC-registered investment firm, Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who has been putting clients' investment needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, good morning and welcome to the Smart Investing Show. I'm Brent Wilsey, and with me is Chase Wilsey. Good morning, Chase. How are you doing this morning?
Good morning. Doing well.
Well, before we get to start here, a lot of changes here this morning that we'll kind of talk about. They're just sitting here talking, kind of look at things, and you brought up, what happened to the inflation hedge Bitcoin?
Well, I see Bitcoin right now because it's an open market, so it's still trading. It actually has fallen below $35,000, now at about $34,887 right now. Looks like the real-time quote for Bitcoin. So as you said, not really the inflation hedge people were talking about, and we said, what proof is there that it's an inflation hedge? It's a risk asset, and that's what it's trading on, not this whole concept of inflation. That was, I think, craziness.
Right, and that's down about 50% from the high, somewhere between, 66,000, 69,000, I think it was for the high. I mean, who knows, you have like different quotes on it, but still, that's a big cut on Bitcoin. And as you said, people don't realize it's a risk asset, and surprise, risk assets just don't go up.
Yeah, I think there's potentially a problem here, and we don't do technical analysis,
right.
But I was hearing people talk about, well, the technical of Bitcoin can't hold 36,000. It's a long way down from there. The thing I was saying to you this morning was, we don't do the technical analysis, but there's no fundamentals for Bitcoin either. Right. So what's going to hold it up? And the big thing that I continue to worry about, and I still think there's enough money in the economy to have those buyers it's a buying opportunity. But the problem that ensues with these risk assets is, again, we know the Fed's starting to take money out of the economy. If money starts to come out, who's going to have that opportunity now to step in and be like, buying opportunity? It's like, I have no cash left. I can't buy into it. You use up all your cash to buy Bitcoin on the dip, let's say. What if it keeps dipping? It's a very dangerous thing, and I won't touch it.
Right, and you remember a week or two ago we talked about the holding of Bitcoin, that about 27% of Bitcoin is held by 0.01% of people, which if they're the ones selling and you're the little guy, you may have an issue because your little investment of, I don't know,
100,000.
Yeah, it's not going to matter when there's millions that are saying, nope, we're done. So we'll see.
I'm curious, too, because you bring up those big guys. They might be saying, I'm still up a lot on it. I'm going to start taking some off the table here, and some off the table could be like half their holdings if they're I'm going to say like a Bitcoin multimillionaire. It's like, I've done well. I think I'm going to start selling off some, and that could create a downward spiral or a continued downward spiral. For
I'll sell my Bitcoin. I'll buy some dollars. Yeah, which is a real currency. Let's move on here. Talking about another one that is kind of been a high flyer. That is bottom's falling out. We're talking about Peloton. The problems keep on coming for Peloton as the stock traded as low as $23.25 this past week. That's a decline of more than 20% just for the day, and it compares to the company's all-time high close of $170 back in January of last year. It was also lower than the IPO price of $29 a share. In terms of market cap, the company has gone from nearly a $50 billion company to about $8.5 billion this past week. What is causing the problems? Well, the company announced it is pausing bike production for 2 months. It had already halted its Bike Plus in December and will continue that through June, and it won't manufacture treadmills for 6 weeks starting next month. So a lot of things going on, but then also, too, there's some controversy coming out. There's other things that maybe that wasn't so true.
Yeah, and I mean, I'm going to continue on kind of with some of the other things, because you talk about the Tread Plus, which is the treadmill, remember, that was kind of killed a couple kids and sent some people to the hospital. They had those. They had to halt that last year, not talking about bringing that back in. But the thing that we kind of brought up in the past with Peloton is, the demand. And right now the company's talking about lower than expected demand as we kind of had that pull forward during COVID. And now there's excess inventory, and that's kind of why they're looking at halting the production. And the thing that I'm kind of chuckling over here, but it's kind of sad, is to make matters worse, the company had some poorly timed investments to add capacity in 2021. They had a $425 million investment into a company called Precor that gave it an additional 625,000 square feet of space for production. And then also announced last May they would be spending an additional $400 million to build a factory in Ohio. Now, the project is not estimated to be completed until 2023, so they don't even have that excess capacity yet. But what are they going to do with all this extra space if demand does not recover? And as you said, the CEO did come out yesterday and said, that report wasn't true, and the stock went up about 10-11% on the news, still below its IPO price. But my concern is when I heard the report, he didn't really have anything, I'm going to say, to kind of reduce those concerns. He said, the report's not true, but we're considering what to do with production.
Right.
It's like, well, are you going to produce bikes or not produce bikes? So I'm still worried to see what their actual plan is. He said it was a leaked report that was false, but I think if the report comes out and it's somewhat true, I think the stock's going to tank even further than the $23 a share.
And we talked about this back during COVID when Peloton was trading, above 100, 150 or whatever it was, saying, well, what's going to happen when the gyms reopen? The thing with the Peloton, we talked about, it's just going to lose the excitement because you're not going to do that for the rest of your life. And here we are, 2022, gyms are wide open, and people kind of using that a Peloton as a nice coat rack is what they're actually using it for, which is pretty expensive for
$2,000. Expensive coat rack.
Yeah. So, but you want one, probably a good time to buy one, but...
I don't know. I mean, they're talking about, what are they going to do with prices? They have somebody coming in to look at cutting costs, and it's just, I'm going to call it a disaster for the company. I mean, and they talk about competition too, like the NordicTrack. They talk about Lululemon coming in. There's other players now in this space because they made it so successful in 2020, but there was no real barriers to entry as we've kind of seen. So I don't like the stock even at these levels. I think there could be more potential problems on the horizon for Peloton. And I did want to say too, kind of bring this up, as people are, the CEO and the other people in the company, they knew this was going to happen. And if you saw they sold stock at $100 a share, I kind of want to get ahead of that because I don't really like Peloton, but I'm going to protect these executives a little bit. The CEO, if you look at all his options and his stock holdings, he sold 5%.
Yeah.
Give me a break there, people. Like, come on.
It's not like the AMC executives, they sold everything, the CEO and CFO. But yeah, I mean,
if he would have sold 50, 60, 70%, I'd be like, he knew something.
Right, yeah. No, and he, it is kind of funny because at 100 was still too expensive. This story reminds me of is years ago, a company called GoPro. They had that camera, and like, this was great. And I think that stock went up to 40.
Last time it was as high as like 80.
Oh, 80? Okay.
I believe so. I remember it going sky high.
Right. And I think now you see it maybe around $6, maybe $10 a share. Companies will come back down to the real value. And is Peloton real value, 20, 30? I don't know. I think it could fall maybe into the teens because that could be the real value for this company. I don't think they've never been profitable, I don't believe. I don't know if they ever will be profitable, but definitely not going back to the 170 it was at before. Let's move on.
Just real quick, I did pull up a chart of GoPro. It hit over $80 a share back in 2014, and then it just plummeted. So if you were one of those lucky buyers back then, you're down about 90% as the stock now trades at $8.92. So again, that's one proof. It's like, the stock will come back,
Right.
Nope.
Yeah,
and we're 8 years later, and you're still down 90% on GoPro. Just buy and hold, right?
Yeah, buy and hold. Yeah, it's a good strategy. Like, no, the company has to have cash flow and growing earnings and growing sales, and the GoPros and the Pelotons. It's just don't think this is a value play. Like, this is a great value. Value is when you're paying less for the earnings. Well, company has to have earnings to do that value play. So let's move on here and talk about another company. This was kind of, I don't want to say surprise, but I think it shocked a lot of people. Talk about Netflix. Has a competition got the best in Netflix. This past week in morning trading, the stock was down over 20%, trading under $400 a share, well off the $700 high. The company said it expects to see a smaller number of new subscriptions at 2.5 million during the quarter than a year ago, when it was 3.98 million.
Yeah, and you just look at the stock, it still trades at high valuations, but you look, I'm going to say, pre-cut, before the major cut yesterday in the stock price, I mean, the valuations were astronomical on this company.
Like 90 times earnings or something crazy.
Yeah, and that's the issue with companies like this. is when you trade off not the fundamentals, because we took a look at Netflix on our Smart Investing channel on YouTube. So if you want to kind of look at that, again, just go to our YouTube channel, and we gave actually a lot more detail. It's about a 15-minute video diving deeper in. But you see the valuations, they were just crazy. And we talk about they beat on earnings, they beat on sales, and the stock was down 20%. Well, how could that be? Because the people that were buying Netflix don't care about earnings or sales. They cared about the subscribers.
Yep.
And we start to lose that, or have that disconnect, I should say, between fundamentals and other metrics. That's where all of a sudden the stock can just crater, because it becomes way, way, way overpriced when you look at the fundamentals of this company. And we still think there could be more downside for Netflix. I don't think the competition's going anywhere, that's for sure.
I think the competition's going to heat up even more. I mean, we talk about Netflix, I believe, spending about $18 billion, HBO Max spending $18 billion, Disney spending $15 billion. You got Paramount, you got all these other ones coming in that they're competing for those people to watch their streaming shows. Well, 4 or 5 years ago, people were right on Netflix because they had no competition. Competition's not good for a business, because it means you're going to lower prices and you won't get as many subscriptions. I do remember in the past years, we look at Netflix and it's like, well, their earnings went down, but the stock went up because subscribers went up. Mm-hmm. So they've never really been a great profitable company. So we'll see what they look like going forward. I want to say, I bet you, well, the numbers, our target buy price would probably be somewhere around $50 to $100 a share.
Yeah.
So.
Yeah. I don't think we would consider that for quite some time.
Yeah.
And I was going to say, too, we are kind of talking this past week about, how people get so kind of wrapped up in, Peloton's a great example. You were up, I think, 400% in 2020 on Peloton. It's like, oh, I knew it. I'm so smart. We talk about how one bad investment or one bad moment can kind of ruin many good investments. And what I mean by that is people are, I've done so well in the market. Well, again, you talk about Peloton. It went up 400%, but now you're back below the IPO price. So if you would have rode that wave and you made a ton of money, you lost all that gain. Or you had somebody that, let's say, did really great investing in a company like Tesla or Amazon, two of my favorites, and they took those profits and bought Peloton at the peak, and you lost all that money. You have to be so careful with things, and that's why we don't get sucked into the hype. Is I don't want to have an investment that goes down 90%. And that's where people, they end up losing so much money, and then they come back and say, the stock market's just risky. It's like, well, why'd you buy Peloton at 200 times earnings? Right. And that's a facetious number. They didn't even have earnings. So. Right. But the point is a very, very high multiple, and it's just a crazy thing to do, and people can lose their shirts when it comes to investing if they don't do simple things, I'll say, or the smart thing by not overpaying for companies.
And you're right, too. And I really hate when people say, oh, the stock market's risky. It's like, no, it's not risky. You make it risky by doing silly things and not looking or understanding what you're investing into, because you're investing in businesses, and that's the bottom line. Now, if you want to invest based on what I call pray and hope that, their subscribers going to go up, or this is going to happen here, and not look at the numbers, you're gambling. You're risking things. And the other thing, too, we talked about in the office yesterday was recency bias, where just because it's happened in the past, you think it's going to go on and on. And if you look at a chart of, we'll just pick on Microsoft. Microsoft's done great over the last few years, but look at a long-term chart of 20 years, and that is not the case. And if you think that the last 3 to 5 years is going to continue on the next 3 to 5 years going forward, you're wrong. Look at the long-term thing, what's going to happen. And it's you look at a chart and your jaw drops because like, oh, that looks strange. So, and Microsoft, great company, but another one, trading at high valuations. Could that go down dramatically? I got to say yes. I know it seems strange. People say, oh, that won't ever happen. But I had one guy on my Facebook the other day, he said, well, I think, no, that was Apple. Apple going to $500 a share. Like, what?
Yeah, and I just, people, they get so wrapped up into it, and they've done so well in particular stocks that, again, as you said, they think it's going to continue on. And I know there's a lot of people with Netflix that thought the same thing and are still probably thinking, oh, it'll come back. It'll come back.
Yeah.
But sometimes it doesn't. And I'm going to implore people actually to do something a little bit different with Microsoft. Rather than, you can look at the long-term chart of Microsoft, but also look at the chart for Microsoft from 2000 to 2017. That's a fun one to look at. because you made no money over that time frame.
Well, that's not so fun.
But I think it teaches people you got to be very careful. And I mean, kind of talking about Microsoft and Apple, it's going to be very interesting to see what happens next week. I believe both of them report earnings next week. And if you get any inkling of bad guidance from these companies, I think the NASDAQ, the S&P, that's going to go down another 5% perhaps next week if things do fall apart for those companies as well. And I'm not sure what's going to happen. I don't try and predict quarter to quarter, but again, we talk about Apple and Microsoft. They're very expensive. They're priced for perfection. If the earnings report and the guidance isn't perfect, they're going to fall, and they make up such a big portion of the indexes that they can bring those indexes down with them.
And we've talked about, too, that I just don't see a catalyst going forward of why things would turn around and go up, because there's nothing great coming down the road. We do have the earnings coming out, which I think you'll get good past earnings like what we've seen so far in a few companies. But the guidance, a little bit shaky. So I think we could be in for a difficult time. And I believe the S&P is down almost 8%. NASDAQ down 12.
Over 10.
Over 10. So, I mean, I think we could have more to go. Correction is 10%. So the NASDAQ is in correction territory. We could see the S&P drop into that as well. But and we talk about Apple and Microsoft. Their CEOs are not cheerleaders. They're pretty honest. I don't see them coming out, well, yeah, we're going to do great the next quarter. I think them being more realistic, saying more about what could be the problems.
Yeah, and I want to be clear, too. I'm not predicting that we're going to have the market go down another 5% next week and Apple and Microsoft are going to miss dramatically on earnings. Right. I'm just saying be very careful if they do. And we don't own these companies. That's the reason we don't own these companies. They're very highly priced. And as I said, if things don't go as well as planned, that's when the stocks will fall. And they very well could come out with good earnings and good guidance, but I don't think it'll send the stock much higher because it's already kind of priced into the stock.
And as we said, I think early in the year, and it's only, January 22nd, that this is going to be a volatile year. So I think what you're seeing now is going to be kind of a picture of what we're going to see going forward. It's not going to be an easy year where everything just goes up and it's down like 2% buying opportunity. No, that's not going to be the case this year, so be careful. And what's causing that is the interest rates. I know that some people are disappointed that the Build Back Better plan did not go through. I was not one of them because I feel that our debt at $29 trillion, that is that's enough debt for now. One thing people don't think about is that if we add another couple $1 trillion to the debt, what happens to the interest rates?
Yeah, I mean, as the interest rates go up, and we know they're going up, the government has to pay more in interest. And you think about it, I mean, just simple numbers here. For every 1 percentage point increase in rates, well, that's an additional $290 billion of federal interest expense. And just think about if the 10-year Treasury increases to 3.5%, 4%. I mean, you're looking at an additional $600 billion a year of new interest expense. And right now, we already know we're having deficit spending.
Right.
So if we have deficits of $1 trillion, and now all of a sudden our interest expense keeps climbing up, well, now our deficit is $1.6 trillion, just to make it simple. And the issue here, too, for interest rates that a lot of people aren't thinking about is we've talked about the Federal Reserve side of things. That's kind of what I'm going to call the demand side. Well, don't forget the supply side of the equation. If we're doing deficit spending here as in the government, that's creating more and more supply of federal debt or those treasuries for people to buy. If you have high supply and low demand, that creates a huge disconnect and increases interest rates even further. That is a very, very big problem.
Hey, I want to pause real quick to let people know. I'm going to open the phone lines, take your questions. As always, with that unbiased, no strings attached. Give us a call at 833-288-0973. Again, that's 833-288-0973. We'll answer your questions on stocks, on economy, whatever it may be. But I do want to finish up on the interest rates because we're talking about the government. Now, what also worries me, too, is that things go too far out of whack. We could see more talk. And again, I think we're safe now for no rises in tax rates. But if all of a sudden you're seeing that debt go out of hand, you got now rising interest rates, they do get some of these silly programs through that are not going to help the economy, just raise the debt level. And I have heard, and again, we don't want to get too political, not a political show, but I have heard they're going to try to break down the Build Back Better plan, get some things through. Well, anything they get through is going to be adding to that debt. This is not the year to do that. You don't want to do that because I I have said before, we can probably go up to $35, $36 trillion in debt and be okay, but I don't want to get there. You know, I mean that's pushing. I think right now we're about 130% of GDP, which is okay. You get about 150, 160. Okay, you get to 200, you could have a collapse. So.
Yeah. And I want to be clear too. I know we've kind of talked a little bit more doom than we normally do on the show. Most of the time we're pretty optimistic.
Yeah, we did some of the dooms.
But I want to be clear too. Is we're not pessimistic on the whole outlook, and I do think there are some issues. I'm going to say grumbling in the economy right now, and we still think there's going to be and it's kind of a funny term. I was talking to a client about it the other day. What I call a healthy recession.
Yes.
Where we're going to have a recession, but it's kind of good to get that reset every once in a while. I don't think it's going to be anything like the financial crisis, which was a crisis. That's dangerous. But, we'll get, I think, a healthy reset. And the right stocks shouldn't fall as much. We might go down a little bit. But, again, you can never time the market, and that's why we don't time the market. We know we have good businesses that can weather any downturns. I don't know if the downturn's going to happen in 2023. Maybe it's 2024. Right. That's why you don't try and time it. But you want to avoid the highly priced stocks because those are the ones that get hit the hardest. And that's what we're trying to alert people of at this moment.
Yeah, and I've been doing this for 40 years, over 40 years actually, and it's just something that I know is going to happen. I don't like it, but it's just part of what you do. And the thing is, we've done everything right by buying good businesses at good prices. We'll weather the storm. But if you have gambled and you've done crazy things, don't know what you're doing, you're going to have issues. Again, we'll be having our client event in March. We'll probably address this for our clients in more detail. But it's just part of investing, and you cannot avoid it. You cannot avoid the ups and the downs. And people think, oh, okay, I'm going to time the market. Well, we know that doesn't work out very well. So you've got to. It really comes back to like when you're playing a football game. You practice how many hours and days and weeks for that game. It's the same thing with investing. You got to spend hours and weeks and many times months looking at these businesses and say, here's the one. And as we always say, well, never buy the absolute bottom or sell at the absolute top. But when you do the right things, you'll weather the storm. And I can't tell what we tell our clients here on air, but I don't say I'm optimistic this year, but I think we'll be okay. Yeah, is a big difference.
Yeah, and I did want to say one thing. I know we got callers now coming in, but I was going to say, that this pullback is going to happen, and we know it will.
Oh yeah,
but we can't tell you when is the problem.
Right.
And people, you missed Amazon, you missed Netflix, before this whole pullback, you missed the Teslas, and you're right, we did miss them. We've been saying they're overpriced for years. But we know at some point everything comes back to the mean. I just can't tell you when.
Right.
And that's why we don't take those chances, because these people that feed into it is like, well, okay, they said don't buy Tesla. Oh, now Tesla's up 200% since they said don't buy Tesla. Now I'm going to buy it. Well, what, you hope it's going to go up another 200%? It's a dangerous game to play, and it's called what we call the greater fool theory, where hopefully somebody's out there that loves Tesla more than you do, and hopefully they'll buy it. But it's a difficult game to play, and you're playing more the emotional side than the fundamental side.
Right. And again, the way we manage the portfolios is by buying good quality businesses, a concentrated portfolio. So we've done very well over the years. You don't have to pick the Microsofts or the Apples at the bottom to do well. And a lot of people that do that, it's only like 0.2% of the portfolio, and maybe now it's 1% of the portfolio. So it's not what you buy, it's how you build that portfolio. And just, I know we got callers coming in now, but just the other thing too, it's not so much about buying that one great company, it's more about the portfolio management of your entire portfolio, how you do. So again, phone number is 833-288-0973. Again, that's 833-288-0973. Let's head up to San Marcos and speak with Phil. Phil, you're on the Smart Invest Show, Brent Chase. How can we help you?
Hey, good morning, guys. First, I want to thank you guys. A few weeks ago, I called in getting some advice on Starbucks, and had to swallow my pride after listening to your show and take the $1.10 loss the very next trading day. And then since that, it's dropped another 10 or 15%. So appreciate your advice on that.
Well, good. I'm glad that worked out.
I've been looking at yeah.
We're not always right in the short term,
like
so it's good when that works out.
What was that, Phil?
No, I'm looking at something now, and I was trying to do my backdoor calculation on EPS and was interested in the fundamentals on ROST. And the way I see it is is it worth a look if it drops below 90?
Yeah, and it's funny because I did look at this myself, I'm going to say a week or so ago, so I'm glad you called in about it because I want to take a look at it again. I was not very impressed a week or two ago, but let's look at the numbers now, see where we stand. Again, the company is Ross Stores. Their symbol is ROST. Not much short on the company, 1.6%. 88% held by institutions. We do see the last report for earnings was October 31st. PE ratio 21.2. That's not great, but the industry's at 25.8. Price to sales 1.9, same as the industry. Price to book value 8.5. That's expensive compared to the industry at 5.8. Price to tangible book value 8.5, half the industry at 17.3. We do see price to cash flow 17.3 versus 16.2, and a good PEG ratio here of 0.2 versus 2.3. Now, looking at the growth, the one-year earnings per share change up 428%, well above the industry at 114%. I would want to kind of know that sounds pretty high. Did they have some sales, or was it very low the year before? Something. 428% growth on your earnings over the year is pretty high. We do see a nice sales growth as well for the 1 year, up 42.9%. Industry 19.6%. Looking at the dividend, they pay a 1.2% dividend. Only use 18.9% of their earnings to pay out that dividend. And then look at the balance sheet. You've got a current ratio of 1.8, about the same as the industry at 2. Unfortunately, debt to equity 1.4 versus 1.2, and that's about my top for a limited debt to equity is 1.4. Looking at some other things here, we do see that their day sales outstanding look good at 3.2 versus 15.3. A lot of turnover there, which is a positive. Net profit margin looks good at 8.8 versus 7.2, and return on equity very good, 40% versus 24.3. Very important with what's going to go forward here. Chase, what do you see?
Yeah, so to start, current price here for Ross Stores, $95.43. I do see it's pulled back quite substantially. 52-week high here, $134.21, and the low, $95.05. See year-to-date return down about 16.5%. So we've seen, not a great start for the year for this company. And it's been interesting, this one, and I think it's TJ Maxx, I think, is the owner. I know they own a couple different things, but I've always liked the concept of these like discount stores, but they've just traded so pricey, and that's one thing too. Is a lot of times people are like, "Oh, that's not a growth stock. Oh, it's not a value stock. It's
right.
very, very pricey," and it's interesting to see how much this stock has pulled back with the correction in the market. But going forward, that's the important part we want to look at to see how much we're paying for those future earnings. I go to January 2023. I see estimated earnings per share of $5.36. Would give us a target sale price of $88.98. So I know you're talking about if it falls below 90. I mean, if it falls below 90, it's still, I'm going to call it about fairly valued at $90 a share. So I don't think that would pique my interest at that point either. But I will say January 2024 is what we'll be looking at here for companies like this probably come, I'm going to say mid to late February when they report for their fiscal year.
Yeah. And the thing, too, Phil, that we like is a lot of people still like this type of concept as you talk about, the discounters are great and so forth. That's not when you want to buy it. You want to go against the grain. You want to buy it when everybody hates it because, it's over for them and so forth. Then we could see the stock price, if it were to happen, maybe fall down to $60 a share, which would be a great buy then if this target price stays the same with those earnings. So you don't want to kind of follow the crowd, so to speak, because I'll never forget CNBC years ago, they had this thing with penguins. And they just showed the penguins just following one penguin off the cliff there. Well, it's the same thing. You don't want to follow investors off the cliff. You want to find that diamond in the rough that will grow over the next, 2, 3, 4 years that you got a good price on it. So with Ross Stores, we're going to tell you to be patient with it and not buy it even below 90.
Yeah, and the hard part, too, is the issue with stock prices kind of falling. Like you've seen, I mean, it's fallen and from, 135, I think I said. And it's like, it's a buying opportunity. But the problem is you kind of had these growth and momentum investors. Well, they've kind of started to leave the stock. Well, then there becomes this point where there's this middle ground where the growth and momentum investors are no longer interested in it. And the value investors like ourselves are saying, well, I mean, it's fallen, but not far enough yet to actually make it a true value stock. So how long is that middle ground going to be until it hits that value point? or it becomes appealing into growth and momentum investors. So it's kind of teetering right now, and that's where stocks can really, I think, struggle to find that ground is what philosophy is it going to fit into?
Yeah. So does that help you out there, Phil?
Yeah, thanks very much, guys.
You're welcome. Thanks for calling. Have a good one.
All right, you too.
Bye-bye.
Bye.
All right, that does open the phone line, 833-288-0973. Again, that's 833-288-0973. Chase, we do get requests from people by email. If you want to send us an email, don't want to come on air, you can do that. Go to our website, smartinvesting2000.com. That's smartinvesting2000.com. You can send the email to myself or Chase. This comes from Johnny. He says, I doubt I'll be able to call, call in tomorrow, but if you could run the numbers on John Deere, I think this ticker is DE stock, and what you guys think of it, he would appreciate it. So let's take a look at John Deere, their symbol. I believe it is DE. Is that what you came up with, Chase?
DE is correct, yes.
DE is correct. Okay, so, and quite an interesting company here because of will it do well going forward? So I'm kind of excited to look at this one here to see what John Deere looks at. And John Deere is more of a farming type company versus a Caterpillar that's more big construction. And farming, I know that they have there's a lot of inflation going on. Their prices are going up. Could this cause good things for John Deere going forward? So let's look at the numbers here on John Deere. Again, symbol is DE. They are in the farm and heavy construction machinery industry.
Okay.
Not much short on it at all. 0.6%. We do see that they have a PE ratio right now, 19.2, just slightly above the industry at 17.4. By the way, if you want to know, the S&P 500 PE, 26.4. Price to sales, 2.6 versus 1.3. That's expensive. Price to book value, 8.1, about half the industry at 17.7. And then price to cash flow, 14.8 versus 12.3. Now, the PEG ratio is still looking okay, 1.4 versus 2.4. Remember, PEG ratio, you do want to lower than the industry average. Their earnings 1 year up 118%, better than the industry, up 95%. Sales did climb by 24% when the industry was up only 18%, so that's a positive for the company. They do pay a 1.2% dividend, only use 18.9% their earnings to pay that out. Taking a peek here at the balance sheet, we got a current ratio of 2.1, slightly better than the industry at 2. Unfortunately, debt to equity pretty expensive, 260%. Versus 160%, so I don't like seeing that. Now they could be like a auto manufacturer because they may be carrying the debt when you buy a tractor from them. That maybe they carry that, so you got to look at the 10Q, 10K to find more detail on that. We do see. Let's look at days sales outstanding, 35 versus 82. That's a positive. Looking at the net profit margin, 13.7, very good. The industry is at 7.7. And the return on equity is 32.4%, above the industry at 25.7, and return on capital 9.4, same as the industry. Chase?
Yeah, and the interesting thing I look at, too, is that debt to equity. You kind of mentioned it. I know Caterpillar, for example, their balance sheet always looks terrible.
Yeah.
But I haven't looked at it, I guess, in more detail in recent years, but it was always a really good balance sheet, even though it looked terrible, because, as I said, they carry the financing. I'm willing to venture and say that's the case here with John Deere, but you do want to check the operating debt as well. But looking at the current price here for John Deere, $364.28, the 52-week high, that's $400.34. So we've seen a pretty decent pullback here on the stock. 52-week low, though, $278.95. I see year-to-date stocks up actually about 6.2%. Now, if I go forward to, 2023, it looks like they report on a fiscal year, October 2023, that is. I see they have estimated earnings per share of $25.15. Actually gives us a target sell price here of $417.49. Now, I don't believe that gives us quite enough for our margin of safety of 30% that we normally like to see.
That's only about 10-15%.
Yeah, but this is one I honestly kind of like. It's one I might put on like a wish list.
Right.
Where if it kind of gets wrapped up in the stock market volatility and goes down with everything else, it could be one of interest. And I say this because reading an article, I'd want to do a little more research on it, but they're talking more about these like autonomous tractors.
Right.
And you know, kind of creating more service revenue. And this is one thing an industry like the auto industry and Caterpillar and John Deere have struggled with for years is it's so cyclical. Well, if they can get more subscription and service revenue, you kind of create less volatility in their earnings. And I mean, they were talking about, I don't know anything about farming, but how you kind of got to drill down and you plant the seeds. And they said it's a very manual process, but they're working on processes to automate this. Well, gosh, if I'm a farmer, I'd want that new John Deere tractor where I don't have to do that all the time. That could be something that creates kind of like a super cycle for tractors almost from the farmers. And it creates, again, that recurring revenue. So I think there's potential here. I wouldn't buy it at these levels, but maybe it's something of interest to watch.
And I think what you have to kind of look at before you go on John Deere is understand how much comes from the farming industry, how much comes from construction. Because I have seen every once in a while you'll see like a big backhoe from them or something, but very rarely. So my guess is, and when you invest, you shouldn't guess, is that a big portion, maybe 70%, comes from the farming industry, which I think would be a positive. And but check it out. Make sure that's the case, because if it's not that, and I'm wrong, because who knows? Maybe in overseas, John Deere is big with people. I don't know. So you got to look at the numbers and the information to verify that, and then you can say, yeah, this does make sense. And then you mentioned about the automation. Again, we talk about the labor shortage. Well, it's not one farmer out there planting seeds.
Well, they don't have to hire people to do that.
They don't hire people to do that, which is very labor intensive. But that is something that could help. And then you didn't mention, I don't know if it's true as well, will they go EV? I mean, can it be electric, or is it going to be still, I think they use diesel is what they probably use on tractors. But so it could be an exciting industry. And one thing that we always need to do is we always need food. And if you can produce more food for less price, that would help the farmers and everything else. And farming now, I think it's like 1% of our total economy, because it's usually big farms. You go up, 15 towards LA, and you got acres and acres and acres of big farms that are actually now it's big business, not some little farmer with 10 acres, planting corn.
Yeah.
So, but I think there's something interesting on that. But here again, you want to be patient. I think you said year to date it's actually up 6%, which is a good sign that it is going, because there are companies that will do well with inflation. So I'm thinking maybe the food thing could be why that is up year to date.
Yeah, could be. And it kind of helps fix the inflation problem, perhaps.
Yeah, exactly. All righty, phone number is 833-288-0973. That's 833-288-0973. We have all lines open, but right now it's time to talk to our financial planner, Harrison Johnson. Good morning, Harrison. How are you doing this morning?
Good morning, guys. I'm doing well. How are you doing?
Well, good. I know today, and this is very important, making sure that your financial plan is organized. Now, that sounds simple, but I bet you there's a lot of people that is probably not very organized at all on the financial plan.
Yeah, so really what it comes from is you want to understand the total repercussion of all the actions that you're making so that everything you're doing is aligned with your overall financial plan. So I've got some examples just based on people I've talked to recently. So the first one is I was talking to somebody yesterday, and they've got money invested at a few different places with different advisors, which is pretty common. But one advisor has an IRA, another advisor has a Roth account, another advisor has an after-tax trust account, and so they're kind of all spread around. And the advisor with the Roth account was having this person contribute to that Roth using a backdoor contribution because this person has relatively high income. So the idea is, okay, you make too much money, we'll have you contribute to a traditional IRA with a non-deductible contribution, convert it over. You don't pay any taxes on it. You can fund the Roth going forward. I've talked about that previously on the show. So that's what this person was doing. But the problem is that advisor didn't know that this person had another pre-tax IRA somewhere else. So really what was happening is they were funding an IRA with a non-deductible contribution, but on the conversion, because of all the other pre-tax money, that conversion was actually mostly taxable. So this person was paying taxes on funding this Roth account, essentially making Roth conversions at a time where it was not efficient to be doing so, especially since this person was in their 50s. They were planning on retiring soon, which means they would have plenty of time to convert to a Roth at a lower tax rate once they no longer have wages anymore. So it's an example of, you thought you were doing the right thing by saving money in a Roth, but really what it was doing was costing you extra taxes at a bad tax time when you're in a higher tax bracket.
Hey, Harrison, this is such an important thing that you bring up, because a lot of times people go to a financial planner somewhere else besides our firm, and they're only doing that one part. Or they say, well, we can only do a financial plan for you to have everything here. I want to point out that at our firm, we understand that sometimes people, even though we don't do it, want to do growth investing. So with you as our financial planner, you're not going to say, well, you need to bring everything out to Wills Asset Management, or we don't do a financial plan for you. You actually look at, again, their entire financial plan, which would include money they maybe have with us, maybe money in another firm, their outside real estate. Very important for people to understand that, because a lot of financial planners, unless you give them everything, they won't do a financial plan.
Yeah, a financial planning recommendation is not, okay, well, you just need to invest your money with this person. No matter where your money is, you can do things. It's, from what I look at, it's more about what type of accounts are they, how much money is them, and how can we make them more efficient and align with the rest of your assets, the rest of your cash flow, your tax situation, and what you want your life to look like going forward.
Yeah, it's such important. So, again, thank you for calling in this morning. We'll see you on Monday morning, and have a great Saturday.
Thanks, guys. We'll see you Monday.
Okay, bye-bye. Again, that's Harrison Johnson, our financial planner. Again, if you do want a free consultation with him, a couple ways to do it. One, call the office at 858-546-4306. That's 858-546-4306. You can speak with him directly through the phone tree there. You'll hear his name. Or you can go to the website, check it out a little bit more at smartinvesting2000.com. That's smartinvesting2000.com.
I was going to say, too, kind of while we mentioned the website, I did want to bring up one more time about our YouTube channel. We talked about Netflix a little bit at the beginning of the show, but you may have missed it. So, number one, you can go check out our podcast if you missed it on our website, smartinvesting2000.com. Or if you're curious about Netflix, we did do one of our Smart Investing weekly stock analysis yesterday about Netflix. And again, you just go to YouTube, type in Smart Investing with Brent and Chase Wilsey. You'll see our channel there, and then you can subscribe and watch that video we did on Netflix there.
Yeah, we usually do them every Friday.
Yeah, last week we had an appointment that went longer than anticipated, so we missed last week, but we're pretty good about doing it.
You always come to my office. All right, we got to do the YouTube. Like, okay, we'll do the YouTube. It only takes like 15 minutes, but it is. We enjoy doing everything. We enjoy managing the money. We enjoy talking with people. Enjoy doing the radio. Enjoy doing the TV. Enjoy the YouTube. So it's things that we enjoy doing a lot. So what we do enjoy is getting phone calls from people. And I just looked over, like, people think, oh, they're probably busy. Last week we were so busy. This week, right now, all phone lines are open. So if you have a question on a company stock that you're looking at investing in, or you hold it, not sure if you continue holding or not, or maybe you just have other investment questions about, is now a good time to invest, the economy, give us a call here, 833-288-0973. Again, that's 833-288-0973. And one thing I do want to talk about, Chase, now the calls aren't coming in, but I do want to talk about the metaverse.
Oh, I was looking at that one.
I thought you would be. Yeah, people will probably say that we just don't get it, but we do think this whole concept of the metaverse is getting just a little bit crazy. And now, am I the only one that thinks that? It's weird that people are buying virtual land for millions of dollars. As an example, a company by the name of Public Realm spent $4.3 million on a parcel of virtual land in some place called the Sandbox. Crazy.
And people are also talking about going to concerts in the metaverse, buying shoes in the metaverse, or I've even seen videos of people grocery shopping in the metaverse. I'm like, who likes grocery shopping? If I'm not going to spend my free time grocery shopping in the metaverse, I don't know if you get like real food delivered to you, or it's just something you're doing in the metaverse. But if you just get it delivered and you pick it out online, I'd rather just click online rather than going through the grocery store in the metaverse.
I'm not crazy. I'm not really excited about going to the grocery store anyway, so why would I want to do that virtually? I guess it's a good way to diet, because I guess virtually you're getting no food, so you're not going to gain any weight. But this whole thing, and I think it is just the next step for kind of gaming. I I mean, you feel about things, you're going to feel good. But again, when you take those goggles off, you wake up like, oh, reality, I got to go to work. I got to do things because you got to make the money.
Yeah, and I think there's something to it where I think people are going to really enjoy the gaming aspect, but I don't know, like my younger brother has the virtual reality headset, and it was kind of cool, but it's not something I wanted to really do again. It's cool to see,
right?
But I was like, he was killing like zombies or something, and I was like, it's really interesting, but I don't really want to do that anymore. Yeah. It's fun to do once, and after that, I think that's going to be a lot of people. It's like, oh yeah, it's interesting, but I'm not going to invest in the metaverse.
Yeah, and I know they're going to improve the technology, but I put those things on in a minute. I get all dizzy and everything. It's just like it's not for me, but I'm sure they'll enhance that as time goes on.
Oh, I think I was out for like 2 hours after I did it. I
had
to go I was at your house. I had to go lay on the couch for like 2 hours because I did not feel good. I got super motion sick from it too.
I'm getting motion sick just thinking about it.
It's actually funny. Harrison was over there, and I punched Harrison because I couldn't see him. I was like spinning around. I almost ran into the TV, and I punched Harrison.
We're gonna keep you away from that gaming system.
The metaverse wasn't made for me, I guess.
I guess not. So let's go back to the calls here. Let's go out to Wayne on a cell phone. Wayne, you're on the Smart Invest Show. Brent Chase, how can we help you?
Morning, gentlemen. Happy New Year.
Good morning.
I'm good. My question is about Arrow Electronics, ARW. It's got a low PE and a high earnings per share.
Okay, and do you hold that or looking at buying it?
No, I'm afraid to buy anything yet.
Well, let's see if we can give you some reasons.
Advice.
Yeah. Let's see if we can give some reasons to get in this company. Again, company is Arrow Electronics, symbol ARW. Not much float on it, 2.3%. 99% held by institutions. Now, that could be a problem because of the fact if they all own it, who's left to buy it? But let's look at the numbers here. We do see a PE ratio of 9.6 versus 14. Price to sales, 0.3 versus 0.4. That's a positive. Price to book value, 3 versus 10. And price to cash flow, 15.8 versus 20. And a very nice PEG ratio of 0.3 versus 3.4. Now, we do see on the earnings per share growth, 1 year up 74%. That's very good, but the industry did better at 91%. Sales are up 18.3. That's above the industry at 16.4. They do not pay a dividend. Look at the balance sheet here. You got a current ratio of 1.4. Not as good as the industry at 2.0, but that's okay at 1.4. I still feel comfortable with that. Debt to equity, 50% versus 30%. That's okay. We do see day sales outstanding 100 versus 73. You want that number lower, so that could be a problem. We also do see a net profit margin of 2.9 versus 2.5, and return on equity looking pretty good at 18.8 versus 15. So far, everything for me looks pretty good. Chase, what are things like going forward?
Yeah, so current price here for Arrow Electronics is $124.67. The 52-week high is $137.95, and the 52-week low, well, that's $96.40. I see year-to-date down about 7.1%. Kind of declining. I know probably why you're a little nervous to buy things, obviously, right now, Wayne. But, hey, maybe this is one to kind of add to, again, a wish list and see if it falls further. It could be an opportunity. And I say that especially...
Like 30%?
I don't know if it's going to go down 30%, but
that's your number, remember, 30%.
Oh, 30% is the margin of safety, and this company's got more than enough margin of safety because I look forward to December 2022. I see estimated earnings per share of $16.22. I mean, it gives us I'm going to say almost outrageous target sell price of $269.25. This company is trading at such low valuations. Now, one thing I'll point out is I see 2021, the company's estimated to have year-over-year growth on its EPS of about 88.6%. Next year, it's about 11%, but then it drops down to just 1%. So I'm not sure exactly what this company does. I believe they sell some type of electronics. Are you aware of what they do there, Wayne?
It's basically just some electronic problems. I don't know if it's for the computer industry or the defense industry, but I know they're electronics manufacturer.
Okay, because I'm worrying again about the cyclicality of the earnings because generally when companies trade at valuations on the forward PE of under 8, it's either a smoking hot deal or it's a value trap. So that's where I'm looking at this is this a value trap where the multiples look great, or is this a potentially wow deal on Arrow Electronics? So I
was impressed by the earnings per share. Currently, I think it's about 13.
And it's how long can those earnings last? Are they sustainable?
Right.
Or all of a sudden are the earnings going to go from 13 down to 7? And that's where issues can ensue.
Yeah, and I think it'd be very important to understand more what this company does. They reported, let me see when they reported, September 30th. So probably the next few weeks, you'll get the next quarterly report. I think I'd probably wait till that time frame to see what the executives have to say about the company, but really understand what the business is, because if this has something that's going to help with inflation or the chip industry, something that's going to be in high demand, you may not buy at the absolute bottom, but it could be good going forward. And again, when we buy companies, we're looking 2-3 years down the road. Could mean you buy the stock at what said the current price was 124. It could drop down to 110. Like, shoot, I missed it. But then a year from now, it could be at 170. So look at what they do, understand the business.
And I just very briefly reading their profile, this intrigues me. They market and distribute semiconductor products. So it's intriguing because is this potentially a play on the semiconductor shortage as well? I don't know enough. I'd want to spend a little more time, again, looking at exactly who they sell to, what do they sell, because we know that there's an issue with semiconductors, and maybe this could be a potential benefactor of that as well. So I think there's some great potential here, but again, definitely needs a little bit further research there, Wayne.
Do you think the interest rate hike, even if they raise it from 0 where we are to 2% over the next year, the quality companies are still going to stay in business? I mean, I have no problem with these meme stocks getting taken out of the market, but I don't understand why the market has been selling off. I know the NASDAQ has sold off twice as much as the S&P and the Dow. I understand that, but there's plenty of major companies that still are going to make money, no matter within that interest rate range. You know what I mean?
Yeah. Many times people don't understand that your higher quality companies, they could pull back a little bit, but not as much. It doesn't mean they'll keep going up. And this downturn is not going to last forever. We will turn it around, and that's what will happen. The big quality companies that are good, and not just big, but quality companies, they will rebound because they've got the solid earnings. Who will not rebound is your high flyers like the Pelotons and so forth. So that's why I've been successful for 40 years, is because I've stuck to what I know works here. And it doesn't mean it works every single day, but it works longer term. So I think this will be a rocky year. I can't tell you what I'm telling our clients, what our prediction will be for this year, on what we plan on doing, what I think we can do this year. But you can make money in a difficult market. You just got to be patient and buy right.
And the big thing that Brent said there, too, that I want to point out is we'll still go down, but we'll come back. And that's the issue, is if you go down and you don't come back, or you fall a lot more than by holding these kind of, I'm going to say, more stable companies, that's kind of how you beat these periods, is by owning the right businesses. And a lot of times people sell first and ask questions later, and people forget that just the shares that are kind of outstanding, what moves the market, is just 0.3% of the shares outstanding is actually what kind of dictates that stock price on a daily basis. So it's people like yourself that are maybe looking at the stock, maybe you're seeing these people that are just selling it and selling and selling it, and it's not really creating enough of a floor just yet. So yeah, that's just something to consider there.
All right, Wayne.
Thank you very much, Shimon. Happy New Year again.
You too. Thanks for calling. Bye-bye. All right, that opens the phone line, 833-288-0973. Let's go out to Amelia on a cell phone. Amelia, you're on the Smart Invest Show, Brent and Chase. How can we help you? We lose you? One more time? We are connected, right? Okay. Well, okay. Next, let's go out to San Diego and speak with Jim. Jim, you're on the Smart Invest Show, Brent and Chase. How can we help you?
Hi, Brent and Chase. I'm interested in what the numbers look like for Tudor Perini Corporation.
For what?
Please. Tudor Perini Corporation. I think it's TPC.
Oh, TPC? Okay, we had the wrong symbol in there for you. So let's see.
Or is it the Toro company? What's the name of the company?
TPC is a
TPC.
symbol.
Okay.
So I get Tudor Perini is the company. Symbol is TPC. They're in the industry of engineering and construction. That's what we're talking about here, correct?
Yes.
Okay. So, Jim, do you hold that or combine that one?
I hold. It's a very small amount, but I'm just curious if I should keep holding it.
Okay. Well, let's take a look at Tudor Perini, symbol TPC. We do see a short float of only 3.9%. Institutional ownership, 68%. Great PE ratio here at 6 versus 21.8. Price to sales, 0.1 versus 0.6. That's positive. Price to book value, 0.4 versus not material for the industry. Price to cash flow, nothing there, unfortunately. I'm not sure why, because they got the earnings. And then we do see a PEG ratio of 0.6 versus 16.2. Now, unfortunately, over the last year, their earnings have dropped by about 9.9% when the industry was up 27.5%. Sales were down actually 0.1% when the industry was up 4.3%. So you really want to understand what is going on here, why their sales and earnings not doing well. Something happened this past year. Will it happen going forward? I do see a 5-year growth rate of 10% versus 7.6%, so that's a positive. They do not pay a dividend. Looking at the balance sheet, got a nice current ratio of 2 versus 1.3. Debt equity also looking good, 0.6 versus 0.9. And then net profit margin, 2%. Not quite as good as the industry at 2.9, and return on equity 6.1, also not quite as good as the industry at 9.9, and we like a return on equity of about 15%. Chase, what about the company going forward?
Yeah, so current price here for, again, TPC Tudor Perini is $11.45, really taking a hit off the 52-week high of $20.24. And the 52-week low, well, gosh, $11.45, so it closed at its low yesterday. I see year-to-date, it's down 7.4%. It is a pretty small company with a market cap of just $584 million, so quite tiny there. But I'm going to say I'm pleasantly surprised there's 3 analysts for a company that small. They have an average estimate for earnings per share in 2022 of $2.06. I mean, it gives us an extraordinary target sell price of $34.20, and I would think this would be a benefactor of the infrastructure that we need to kind of accomplish, and I think that's probably why it's pulled back. It hit the hype last year during the infrastructure deal kind of going through and stuff, and perhaps pulled back. But, I mean, the valuations look good. Small caps just always kind of worry me because you're a little bit more on your own, and they tend to be more volatile as well.
Yeah, I did notice that the 10-year return on this company, a negative 27%. So, and that can happen with small companies. They kind of get lost interest, and you're stuck in that company for a long time. So I know the target sell price look pretty good. But
one fun fact before we got to go here is it was founded in 1894. It's been around for a long time.
And was the stock price $11 back then? I don't know.
I don't know.
Yeah, it's a long-term company, but I mean, it's something that we would not buy. And also, too, what could happen to this company if it goes much lower, it could be kicked off and be on the pink sheets and not being traded at all. So I would probably recommend stay away from this one here. All right, Jim?
That's good advice. Hey, by the way, as far as the metaverse and everything, don't you miss those days when people would read a book or something, have a little paperback book?
Yeah, those days I think will still be around, but for less and less people, I think.
Yeah. Okay, well, thanks for your advice. Appreciate it.
Okay, Jim, thanks for calling. Have a good one. Bye-bye. All right, I usually say that opens the phone line, but I look over like, where'd the time go? Where'd that hour go?
It goes quick.
It does go by quick, yeah. So great callers today, some great information. I did have one that called in on the cell phone. I wanted to talk to them because they're talking about NVIDIA.
Yeah, Amelia.
Yeah, that would have been great to kind of talk about NVIDIA to see those numbers. I know they pulled back quite a bit as well.
I think they're in bear market territory, down over 20%.
Oh, really? Well, I think their high was it 360?
I don't know the numbers. I just know they're down more than 20%.
I think their high was like in the I would say 340, 350 range. Now about 220.
Yeah.
Well, there's a closing bell, so thank you for listening to the Smart Investing Show. It is for informational purposes only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs, have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-546-4306. That's 858-546-4306. And be sure to visit our website, smartinvesting2000.com. That's smartinvesting2000.com. And for more daily educational information along with investment tips, go to our Facebook page, Smart Investing with Brent Chase Wilsey. Have a great day. We'll talk more next week right here on the Smart Investing Show.
To think that I did all that